Okay, traders, today is Tuesday, September 16th, 2008, and we are looking at a soybean chart. This chart, traders, I was looking at as we did homework last night on Monday night for Tuesday, and in the chat rooms, I mentioned to many of you that I thought beans looked terrible here, and that beans were probably going to have a down day. Now that, coupled with many other commodities starting to head down, and the fact that currencies had a two-day rally and bonds had a big rally, all before the Fed is going to make an announcement this afternoon, seems to bode well that the dollar will rally and push these commodities back down further. That means that the Fed will likely not lower rates. I would think if the Fed was going to lower rates, you would see the dollar getting hammered, you'd see currencies rallying, and you would see commodities begin to rally, because if dollars go down, it makes the price of commodities and goods go up. So maybe this is foretelling that there'll be no rate cut. And I don't think there'll be one, but that doesn't mean there won't be one. I just don't think there will. In any event, we're looking at a soybean November daily bar. Now, we have not had to really look at head and shoulders formations in quite some time, so this is bringing us back to a head and shoulders class. Interestingly enough, they're starting to form again. What you're looking at is a very easy to spot head and shoulders and the breakdown from such. I would think a simple projection of this head and shoulders would give us, let's do a conservative projection here. And let's say we'd probably end up somewhere down here, 1019, 1020, based upon this head and shoulders formation. Very easy to spot, right, traders? You can see the head and shoulders. Anybody have difficulty spotting that? Now, not that I want to go on about a head and shoulders class again today. I didn't think I'd be in one, but hey, they are what they are, and we trade what we see, not what we hope for. Double X, you don't see the head and shoulders there? You gave us a no answer? Okay. Now, do you think that's a head and shoulders? Just watch this. That's got nothing on the real head and shoulders that has developed here in the soybeans. There's a few different ways to draw this one up, but nonetheless, it is a massive head and shoulders that has built over here. Let's turn these circles another color. Let's use red for the bigger head and shoulders that has developed. All right, so if the head and shoulders is actually this, and why I say there's many ways to draw it up, traders, we can start fresh and we can draw it up like this. You go, head and shoulders here. Looks to me like we should probably drop. And then the drop does begin. But when you erase the smaller head and shoulders, you'll realize that that head and shoulders is really encompassed inside of a shoulder, because the shoulders are enormous here right now. Look at the size of this shoulder. In fact, I'll make it even bigger. Let's encompass all of this and call this the shoulder. And we'll call this the head. And we'll call this the right shoulder. And now I think it really comes into focus for you. It's enormous. Look at the size of this thing. Now, based upon this head and shoulders, there is a possibility that beans can really, really break here. You could end up all the way down, somewhere down here by the time the year is over. We're talking down in the 8s. Now that is being a bit zealous, maybe even overzealous here. But it is what it is. I mean, it is what it looks like, right? And you almost never get below the 200 bar moving average. And once it started to rock and roll below it, and then it finally failed, look at the size of the break you're beginning to get. So you have a massive head and shoulders looking like it's going to really push down the soybeans market. Then, of course, inside of that, you have the head and shoulders right here, which is the one that we noticed last night that was finally giving way to the downside. Now, where did we want to get in? The fact that it was breaking the bottom of this shoulder here, it was getting below this area. We wanted to be sellers as it started to penetrate this area. So you can either sell a rally today or last night into today expecting a drop, or just wait for it to get below the shoulders and jump in. Either way, that was a pretty easy call that the market would start to go lower based on that formation. If you look, this is pretty symmetrical because look at how the shoulders practically are exactly even. The bottoms of the shoulders. Pretty symmetrical in my opinion, and a good reason to want to go short. So there was the short that I mentioned to you last night in the trading rooms. And who were the traders that took advantage of it? There were two of you, right? Who took advantage of the short in the soybean market? Gambler, Lacey. Oh, Lacey didn't do it. Gambler did it. Anybody else in the rooms? Now, I realize it was not an official Omni. And in fact, if this were not a Fed day, I probably would have gone and did a video last night about selling bonds and selling soybeans. But I didn't put the video out basically because I did a very comprehensive weekend webinar video for you traders. And last night was only Monday. I did the video on Sunday. I like the weekend webinars to sit out for a couple of days. But I did discuss with my crew the possibility of us going ahead and doing a video, and then I just decided let's leave the information that's already on YouTube out there until tonight. But here is that setup, traders. It's pretty easy. The formations are telltale, as are the indicators. Indicators look like they would agree with some more downside action. And in fact, if you look at this right here, it is actually a head and shoulders itself, which doesn't always form on the commodity channel index. But here you have one right here. So even on indicators, we're looking at head and shoulders formations. Interesting enough, right? All right, so that's soybeans, traders. I wanted you to see the setup. I know I've done head and shoulders with you many times, but it appeared that many of you didn't even see that one until I brought it out to light. How many of you didn't even realize the big one was there? This one. That is why I go over this so often, traders, because if you're not seeing them, you're going to miss these moves. Redundant as it may seem, that is what we do for a living, traders. We are redundant. We go over and over and over formations and charts, and when we see things that are familiar, we trade those familiar formations. So you have soybeans absolutely pointing towards more downside. Nice big head and shoulders there. Now, let's go look at a bond chart. Yes, I saw the one on the left, but that's when we were in a bull market, not a bear market. So I've mentioned to you many times, in fact, I'll pull that more into focus for you. I've mentioned to you many times that in a bull market, an upright head and shoulders will usually just give you a pullback which can be purchased. Well, we were clearly in a bull market. As I pull the chart back, you will see that. This head and shoulders was clearly within a bull market. So you don't know if that's going to be the high or if that's just going to be a head and shoulders to give you a pullback to be purchased. And because we were in a bull market, that's exactly what it was. I think we have now approached the bear market. So now we look at the head and shoulders and call it topping as opposed to buy opportunity. Now, if we get a head and shoulders on this chart that looks like this, it would likely be an opportunity to sell more on the rally. If we get another head and shoulders now that forms itself like this, that forms itself like this, it would be an inverted head and shoulders, and that would likely give you, in a down move, you get this, and then, of course, you get to sell it. More downside. So when you're in a bearish market, a head and shoulders inverted is another opportunity to sell a rally. When you become, when you're in a bull market, an upright head and shoulders is an opportunity to buy a dip. I know that can be confusing. You have to look at the size of the move that you're in and what part of that move are you in before you decipher whether it is a sell signal or a dip in a bull market. So keep that in mind. They're not the easiest formations to trade, but they are absolutely easy to spot. All right, traders, so now let's go look at the bond chart. Okay, and I would like to erase some of the stuff on here so this cleans up for you a little bit. And then we will take a look at why we sold, where we did, and why it should likely work. All right, traders, as we have discussed, when you see a double top, like the one down here, top, top, you sell a double top. We now have, depending upon how you want to look at it, a double top in bonds. The actual double top, there's a range here which I wanted you to sell into, traders, and my premium room traders did do that. Here was the range I wanted everybody to start selling into if we got above the 121.30 area yesterday. And I thought if we sell in this range, the likelihood is the Fed will not do a rate cut and we will be able to get out with a profit. Now, if you don't see the double top, you should, as I condensed the chart. It will not allow me to pull it all into one picture. Here is that double top, the one from here, and I drew this dotted line, sent it way out into the future so that when we get there, I would be prepared for it. So this top was put in around June of 2003. As you move forward, that red line up here is that double top. Now, you can easily call this a double top if you want, or you can revert back to the one to 2003. Either way, I think that that is a failure spot. We did this very same trade the beginning. Well, we did this same trade when it got here last time, and I believe Trader Vision was with me at that point in time. He was in my chat rooms. If I remember right, he took advantage of this trade. Did you take advantage of this trade last year, Trader Vision, when we put that double top in? Well, I remember calling it, and I remember you being one of the smart guys, and we talked about getting all the way down to 109, and I believe that's what happened. So now we are looking at another double top in a higher range. I think double tops need to be sold always, which is what I am looking to do here. Now, there's a double top in place on a day that the Fed is about to make a decision, and the street seems to have put themselves in a position that the Fed will definitely lower rates, and I don't know that I agree with that. This is a high-risk trade. This trade would only be for traders with larger accounts that don't mind holding it for a day or two, and the ones who were following me have done that. We started selling it right around here, and then we sold it again around here, and then we sold it last night basically right around here. And that was our plan to begin with, sell into that double top and see what it brings us. So that is why we got ourselves into a short position in bonds. Again, it is extremely risky because of the Fed. Otherwise, a double top's a double top's a double top, right? But I trade it that way anyway. I don't care what the news is. I don't care that there's a big fundamental out there. I say fundamentals come out in the charts first. If that's the case, here it is all set up for us, traders. The fundamental is here in the chart. It shows a double top. Double top means the market is about to drop. Now, with that in mind, let's go look at something else. Just to let you know, fundamentals come out in the charts first, and even intermarket fundamentals come out in the charts first. We are going to look at the daily bar of the Canadian dollar. The daily bar of the Canadian dollar gave us a head and shoulders formation. Then it gave us a rally, and that rally stopped cold right around the middle of the head, just before the middle of the head. And then we had a severe break. Now, here's where fundamentals come out in the charts first, and this reverts back to a lesson that we did a couple of weeks ago. Crude oil and Canadian dollars are extremely close or tied together because the Canadian economy in the last 5-7 years has been basically wrapped around all the shale oil that they have found, all the oil that they have found in their shale underground, and it's made their Canadian dollar become quite strong. It went over par with the US dollar recently. And if crude's going up, Canadian dollars are going up. If crude's going down, Canadian dollars are going down, and they are locked to the hip. Well, watch what happens here. You get a huge fundamental or a huge technical picture in Canadian dollar. The head and shoulders, which gets tested right here. Watch what crude does around this very same time. Here we are, 7:15:08, the testing area before the break. Let's go look at crude. 7:15:08 in the crude oil. Here is the high in crude, 7:15:08. Do you see the date? That's this day right here. The fundamental was sitting on the charts on the Canadian dollar, which gave us a notion that crude was about to break. The Canadian dollar broke, the crude broke. The Canadian dollar's been going straight down just about ever since, with the exception of a small head and shoulders. That head and shoulders took place right about here, and now it's breaking down again. Okay, so crude, the fundamental came out in the chart first, in the Canadian dollar. The crude broke with it. Back to Canadian dollars. Here's where we're going to get interesting again. Now, let's do a Dece. Well, we'll leave it with Sep, because Sep's drawn up already. The Canadian dollar, head and shoulders formation, the false rally, the breakdown. Now look at the new head and shoulders that has formed. And let's go back to Dece. There's a new head and shoulders that has formed. Then we broke down a little and rallied up and got somewhere near the head just yesterday, right here on this bar, and could not even reach a test of the head and started to break immediately. Broke all the way down, settled a little less than mid-range, and then started to break down again today. That likely is more downside coming for Canadian dollar. If that's the case, then there's probably more upside coming for dollar index. And if there's more upside coming for dollar index, the Fed couldn't possibly be cutting rates today. That would drive the dollar down, not up. So US dollars should go up based on the chart we're looking at, while Canadian dollars continue to head down. And that would also entail foreign currencies from Europe. So, with that in mind, Euro currency. Euro currency, big breakdown, has a 2-day spike rally, boom, boom, and then, of course, starts to fail immediately following. It has failed already and is starting to break down. Another indication that the Fed is likely not raising or lowering rates this morning. This afternoon now, I guess it is, right? In exactly 1 hour and 1 minute, we're going to get our answer to that. But the charts are telling us that the markets are probably done. They went up, got ready for the anticipated rally or the rumors that the Fed was going to cut rates in US, making the dollar get weak and currencies get strong. They did rally up. That rally looks like it has failed already. Look at British pound. British pound was one of the first to go, as was the Australian. British pound did the same thing, rallied up for a couple of days and stopped cold after a 2-day rally and is now heading back down. Right, so you had rally day 1, and we'll turn this to a down arrow. Then you had rally day 1, you had rally day 2, and boom, it's already starting to come off. Now, the British and the Australian, in my opinion, were the first ones to really give us the go below the 200 bar and below the Omni Proprietary, which is here. Let's go look now at the Australian. Australian dollar came off very hard, another 2-day rally, and then the failure starts almost immediately. 1-day rally, 2nd day's rally. Today, the market opens and begins to drop. Sell 2 days up in a bear market, traders. Okay, that's what this is all about. and it works really, really well. You've just seen this now on a few currencies, right? You want to sell 2-day rallies in bear markets. If the Fed is going to do nothing, it's already in the charts. That is why I assumed that the Fed does nothing. It's already in the charts that the Fed does nothing here, in my opinion. The charts, yes, they're not always right, and of course my interpretations aren't always going to be right, but I think the charts speak for themselves on most days, and I think that we can see that the charts are asking for no rate cut. They're begging us to realize there'll be no rate cut. In my opinion, that's what I see. Now, traders, look at how hard we have broken since we got below the Omni Proprietary right here. It almost never gets below. Once it does, and you know we did a video about this weeks and weeks ago, look at the size break. This, as I have mentioned to you, is not a correcting market. This isn't a bull market that corrected and is now getting bullish. This is a broken market. The market has broken to a bear. So, you've seen that in a few currencies. The dollar, I would assume, is going to be exact opposite. Dollar, what does it do? It has a rally. Then it has one big down day right here. Has another big down day. And immediately assumes a rally posture. This was the video I did on Sunday for you traders. I told you that you would get a couple of days rally in currencies and a couple of days dip in dollar, and that would be your invitation. More than that, I really can't do for us traders. I can point it out before it's going to happen to you. If you do not react to that, then you'll have to miss the boat this time and wait for the next setup. The beauty of what we do is that these setups never go away. They keep coming back. Setup after setup after setup. These charts will be here. These markets and charts will be here next week, next month, next year, 5 years from now. It is okay if you didn't even catch this one. Let's say it happens, the Fed does no rate cut, dollars explode, currencies break, and you missed it. So what? There'll be another setup. But at least you will now have the knowledge that these setups do occur before the actual move takes place. There is a setup to tell you what to do. Does everybody see that, and are you following the logic in today's lesson? Based upon what we've seen, traders, is there going to be a rate cut today? No, right? You'd have to think no. Okay, well, I mentioned that in Sunday's video because I could already see this action beginning. Don't forget, this was Friday's move right here. This first down arrow, that was Friday's move. I already saw what was coming our way. I said, all right, Monday will be second down day, and then look for the upside. That couldn't happen if the Fed was going to lower rates. So that is my assessment of the charts, traders. This is why I feel the Fed does nothing today, and the likely correct position would be short currencies, long dollars, short commodities, maybe long stocks and short bonds. Okay, traders, I think I'm going to end the class right there. I think my point has been made technically, and I hope everybody can see for themselves what I'm looking at here, and that is several markets put together telling me that there's likely going to be no rate cut this afternoon. Thank you so much for coming to class, traders. Now let's go concentrate on markets.
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I am a 24-year seasoned trader on and off the floors. This is how I've made my living for many, many years. Good luck trading.